Welcome to the Mayor Brown's webinar on tax equity structuring and impact of potential tax reform. At this time, all participants are in a listen-only mode. Please note that this conference is being recorded. I will now turn the call over to David Burton. You may begin.
Hello. Thank you for joining us today. I'm David Burton, a partner in Mayor Brown's New York office. I'm a member of our tax, transactions, and consulting group, and I advise clients on a wide range of U.S. tax matters with emphasis on project finance and energy transactions. Joining me today are co-presenters from Alpha Energy Advisors, the directors from that company, Centeris and Vadim. Centeris focuses on providing financial and commercial advice in relation to development, financing, purchase, and sale of power generation assets, such as solar, wind, gas, hydro, geothermal, and coal. Vadim has over 15 years of professional experience in project finance, capital raise, M&A, project due diligence, and valuation. Today we will cover tax equity structuring and the impact of potential tax reform. As we go along, we hope that you will ask questions. If you'd like to ask a question during the presentation, please use the Q&A panel on the right side of your screen. We will make every effort to answer questions towards the end of the webinar. Answers to questions, whether we address them during the webinar or not, will be posted to Mayor Brown's blog, Tax Equity Times, a few days after the webinar, along with the presentation and recording. We'll also send out an email to all registrants with the link to the blog post with the answers to the questions and the presentation and recording. Regarding CLE credits, so listen up if you're a lawyer looking for CLE credits. We will be providing an alphanumeric code at some point during the presentation. In order to receive CLE credits, participants must record the code on the virtual sign-in sheet that was emailed to you with the login instructions for today's program. With that, let's get started. So, here we go. Let's see. Prospects for tax reform. So recently, a capital markets research group put out this study, and as you can see that the likelihood of a tax cut for corporations has plummeted. Early in March, it was up around 75%, and then by mid-June, it's down to below 40%. This market research group thinks that the likelihood of tax cuts for corporations has fallen quite considerably, which is also consistent with my personal view. Prospects for tax reform. I wanted to give everybody a few recent quotes. So these quotes are from just a few days ago, and kind of reflect the latest developments in Washington regarding tax reform. So we'll start with the House Republican leaders. So we have the chairman of the Ways and Means Committee, Kevin Brady, saying, generally, September is the timetable for tax reform. Generally, that fits into the timetable for 2017. I've stopped talking about months and just focused on this year. So before they were saying they were going to do it, by the August recess, then it was, before Thanksgiving, and now they're saying timetable sometime in 2017. Then we have an anonymous House Republican who didn't want his name reported, but this was picked up by the Daily Tax Report, a pretty reliable Bloomberg publication. The goal is to pass a tax bill in 2017. If tax spills over into 2018, the politics in the election year might impede progress. So he's saying if they don't get it done in 2017, it's going to be tough to get it done in 2018. And then Speaker Paul Ryan, he gave a kind of a pep talk speech about tax reform last week, and he said, we need to get this done in 2017. We cannot let this once-in-a-generation moment slip by. So he feels it's important to do it in 2017, but 2017 is passing quickly. We're almost halfway through the year, and health care is still unresolved. So it looks challenging for that to happen. Then we have some thoughts on the prospects for tax reform from the Democrats. So we have a tweet from Minority Leader Nancy Pelosi. She tweeted, I applaud Speaker Ryan on his ability to give so many speeches on tax reform without ever sharing details of an actual plan. Then we had the ranking Democrat on the Senate Finance Committee say, at the rate we're going to have full proposal, somewhere like 2075. So he's not terribly optimistic that that'll happen anytime soon. So that's the Democratic perspective. Obviously, they're in the minority, so they have less influence over the process than the Republicans, but they are the Democratic observations. And then summing up, this was a quote from April I've used before, but I think it's still accurate. And this is a Republican congressman from Florida who was reported in his local paper as saying, the chances of Republicans being able to tackle something as complex as tax reform are fairly remote, considering how hard this health thing is. So I still think that kind of reflects where it stands. Tax reform is a long putt for the Republicans to get it done. But they're obviously trying, and we won't know until it's all over, and we get into 2018. So then, moving on, then the potential effective date in tax reform. So this chart shows what's happened historically. And first of all, historically, generally, tax legislation is effective for the following year. So if it's passed in 2017, it would probably be effective January 2018. If it's passed in 2018, we'll talk about in the next slide. There's some possibility of, if it's passed in 2018, being effective January 1, 2018. But we'll get to that. But generally, tax reform legislation and broad legislation is effective for the following year. Only President Reagan was able to pass tax reform legislation the same year he took office, but even that had an effective date of the following year. And then President Kennedy had a filibuster-proof majority in the Senate and control of the House, and he needed 21 months to pass tax legislation. So President Kennedy actually had a stronger position in the Senate than President Trump's party has, and it took President Kennedy still 21 months to pass tax legislation. So then we have, as I referred to, the first quarter potential for retroactivity. So if tax reform is passed in the first quarter of 2018, there's some speculation in Washington that even though it's passed after January 1st, 2018, that it could be retroactive to January 1st. So people need to be taking that into account, that if tax reform doesn't get passed in 2017, but it gets passed in 2018 and passed in the first quarter of 2018, it could be retroactive to the first quarter of January 1st of 2018. So there is some possibility of retroactivity. People are thinking this could be possible based on some of the healthcare tax-related legislation in the Obamacare repeal has had a retroactive effective date. So possibly there's more tolerance for that now, particularly if it's seen as taxpayer-friendly, such as a reduction in tax rate, which is generally perceived as taxpayer-friendly, although not necessarily a good thing for renewables industry. There could be a little bit of retroactivity. We don't see the retroactivity going beyond the first quarter because then it gets complicated with corporate financial statements and just computer processes and other things. So we think there's some possibility of retroactivity if it's passed in the first quarter of 2018, but not if it goes beyond the first quarter of 2018. So tax reform proposals. What's in the proposals? We still don't have a proposal that's got support from both chambers of Congress and the President. So this is a little bit of piecing together what various proposals have said and what has been said by various policymakers. So the proposals include reducing the corporate tax rate to somewhere between 15 and 25% from the current 35%. Right now, there's been some reports that getting the corporate tax rate below 28% would be difficult. So if we do see tax reform, it'll probably be, on the higher side of these numbers. But President Trump had said he wanted to reduce it all the way to 15%. But that's probably not feasible unless you're willing to balloon the deficit. Immediate expensing for capital investment, so that's similar to 100% depreciation in the first year. So you buy something, you'd be able to write it off all in the first year and not have to depreciated over its tax life. And then some limit on the deductibility of interest. You'd likely be able to deduct interest to the extent you have interest income, but then if your interest expense exceeds the income, that may be suspended with possibly some relief for financial institutions and utilities. So there's a lot of open issues with respect to interest deductibility. Accelerated depreciation would be a nice tax benefit, but the reduced tax rate would make the accelerated depreciation less valuable than it is now. With the reduction in the corporate tax rate, we'd likely see corporations' tax appetite fall overall, likely reducing the supply of tax equity. Although various representatives of tax equity banks that make tax equity investments were at Wind Power. And it was said on panels there that the tax equity market's pretty deep, and that even if there was less tax appetite overall, that the market's deep enough that deals should still be able to get done. So there's some optimism by tax equity investors that there'd be enough tax appetite even with a reduced corporate tax rate. And then just always keep in mind that the tax rate reduction does not impact the value of the tax credits. It may impact the marketability of those tax credits if there's fewer tax-paying entities wanting to do tax equity, but it doesn't impact the value of the tax credits. So whether the tax rate's 35% or 15%, a tax credit's got the same value. Depreciation changes with the tax rate, but tax credits do not. So, and then talking about tax credits, what does tax reform mean for energy tax credits that I think most people on this call are quite interested in. And we feel pretty optimistic that the energy tax credits will not be repealed, that they'll be permitted to phase out, and that's based on some comments from the Treasury Secretary. So when the Treasury Secretary was in his confirmation hearing before the Senate Finance Committee, he was asked by Senator Grassley, a Republican from Iowa, who's a very loyal supporter of the renewable energy industry. He was asked if Secretary Mnuchin supported the phase out of the PTC enacted in 2015, so letting the PTC phase out as it would under current law, rather than eliminating the PTC this year or next year. And Mnuchin said that he did favor the phase out, that he did accept that the phase out should be allowed to stand. So that's a good sign. Grassley did not ask him about the ITC, but you would think that Secretary Mnuchin's view of the ITC phase out would be the same as the PTC phase out. The ITC, of course, has a permanent 10%, so even if you get beyond 2023 when the ITC phase out is done, you still have a 10% ITC, and maybe Secretary Mnuchin would have a different view of the permanent 10% ITC, but it would seem logical that in terms of the phase out between now and 2023 of the ITC down to 10%, that he should, view that the same as the PTC and think that it should be left alone. There is a House Republican group and now also some Democrats some Democratic senators working on a proposal to replace the current energy tax credits with a technology neutral tax credit that would be a PTC, and then the amount of the tax credit would be based on how much the particular technology reduced carbon, and then you'd get it for how much energy produced at that lower level of carbon emission, or even zero carbon emission in the case of wind and solar. We don't think that this would impact the phase out of the PTC or the ITC down to 10%, based on Secretary Mnuchin's comments we talked about. This could impact and be a replacement for the permanent 10% ITC. This would have some policy advantages, this technology neutral tax creddet. That's just, you quantify the tax credit based on how much less carbon your source of energy produces versus a standard, in that it would avoid having to try to shoehorn new technologies into old statutory definitions that may be drafted decades ago and somewhat out of date. So if sometimes new technologies come up around waste to energy or other types of things, they don't quite fit into the current definitions clearly. Well, it would remove that. And also, since the tax credit would be based on production and not on the level of investment or basis, it would reduce the issues about fair market value and basis in terms of quantifying the tax credit, because your investment or your basis wouldn't matter. It would just matter how much clean electricity you produced. But the bottom line is that the repeal of the 2015 phase out of the PTC and phased out of the ITC seems unlikely. We think those will be most likely left alone even if tax reform is passed. So tax equity markets' reaction to the possibility of tax reform. First, we get to how the markets are reacting. So generally, the markets expect sponsor to bear tax reform risk, which is a change from prior practice. So 2 years ago, deals would be drafted, contracts would be drafted for tax equity deals that said that a change in law would not result in a change to the deal. That change in tax law would be the tax equity investor's problem or potential benefit, and the flip rate and the economics of the deal would not be adjusted. That is shifted, and now with the serious discussion of tax reform, tax equity investors are generally looking for sponsors to bear the risk of tax reform. So they're saying to sponsors, you've got to step up and protect me, or else, I'm not doing your deal. There isn't yet uniformity in the market. Probably there won't be because of structuring differences as to how best to pass tax reform risk through to the sponsor. Generally deals with leverage, even back leverage. It deals with a lender who's looking for cash flow from the project at some level to repay its loan. Generally, we're seeing the size of the tax equity investment being sized, assuming tax reform is effective in 2018. So, for instance, you'll see a tax equity investor's model using let's say a 25% tax rate as an example for 2018 and later. So, with a full 35% tax rate in 2017 and then 2018 and later, a lower tax rate of, let's say, 25% or whatever the tax equity investor and sponsor agree to. And then if tax reform doesn't happen and the corporate tax rate stays at 35%, the tax equity investor, after the end of the current Congress, is obligated to put in more cash to reflect the tax benefits it's getting at 35% in 2018 rather than a mere 25 or lower than 35% tax rate. So the tax equity investor is saying, look, I'm a bank, I'm very creditworthy, you can trust me, I will put in more cash if in fact we don't see tax reform, and if in fact I get to monetize these benefits at a 35% tax rate. So that's how we're seeing it done in some deals, so the tax equity investor funding a smaller amount, and when the current Congress ends, saying, okay, I will put in more money if tax reform does not happen. Deals without leverage, we're generally seeing the tax equity investment sized using a 35% tax rate for all years, and then the tax equity investor saying to the sponsor, well, look, if it's reduced below 35% and that hurts me, I want you to indemnify me. So you pay me in cash to make up for the lower tax benefits, the rate below 35%. But again, these are just generalizations, and kind of each deal is pretty highly negotiated and pretty customized, and there's exceptions. But this is generally how things are moving. Deals with the leverage, we're seeing it structured so that the tax equity investor, as I described, agrees to put in more money when the current Congress ends if tax reform is not enacted, because if the tax equity investor demanded an indemnity, so the tax equity investor said, okay, I'll fund my full amount up front, assuming a 35% tax rate, but if I don't get my benefits at 35% due to a change in tax law, I want an indemnity. That indemnity could require so much cash flow from the project that then the lender wouldn't have cash to be paid. There wouldn't be cash to pay the lender. Even if it's back leverage, there wouldn't be cash to pay the lender. So therefore, we see the lenders saying, look, size it assuming more conservatively, kind of assuming the worst case, so that I know what the cash flow looks like coming off the project, and then have the tax equity investor put more money in. because the lender's concerned that the tax indemnity for a change in tax rate could be so large that it would leave it without the project without cash to pay principal and interest. So that's how the market's handling it. The other development we've seen in the market is we're seeing many deals using bonus depreciation. So it used to be that tax-equity investors generally said they didn't want to use bonus depreciation, and bonus depreciation is obviously 50% depreciation in the first year plus the regular 5-year makers on top of that. So we're generally seeing now tax-equity investors saying, okay, I'll claim bonus depreciation in order to monetize as much of the depreciation as possible in 2017 when there's some certainty that the tax rate will be 35%. So we've seen a shift from disfavoring bonus depreciation to now favoring bonus depreciation. For this technique to work and for the tax equity investor to really get the benefits at 35%, we need the tax equity investor to have enough outside tax basis to be able to use the benefits in 2017 and not have the losses suspended under the partnership tax rules. So if you claim the bonus depreciation but it gets suspended because of insufficient outside tax basis, it's not all that helpful. So if you want to use this structuring technique, you need to make sure that you have enough outside tax basis to use it all in 2017. Otherwise, if you end up suspending the losses and taking them in later years, you're still exposed to tax rate change risk. And just as a note, my colleagues from Alpha Energy Advisors will get into this in later slides, but just as a note, a deficit restoration obligation or a DRO doesn't solve this particular problem. You can provide however large a DRO you want to, and if you don't have enough outside tax basis, it still gets suspended. So the bonus depreciation is a good idea, but for it to really work, you also have to make sure your outside tax basis calculations work in a partnership deal. If you're doing a lease, that's not an issue. Okay, tax equity returns. So this is a more general discussion. So moving on from tax reforms, so we're seeing tax equity returns for wind. We're seeing them between 7% and an 8.5% after-tax internal rate of return. For utility scale solar, we're seeing the same types of returns as wind. So there's no longer a premium for utility scale solar to wind. However, there's not a whole lot of utility scale solar deals out there because utilities have been reluctant to sign PPAs in recent years. So there's a few out there, but there's not that many. So utility scale solar is also a little bit rare. But when we do see it, we're seeing the after-tax IRR pretty similar to wind with no premium for it being solar. In terms of rooftop solar, we're seeing higher premiums or higher rates of return in those deals. We're generally seeing between 9 to a 12.5% after-tax IRR. Sometimes even higher than that for small commercial projects or finance one at a time. The tax equity investor says, look, if you want me to do a small, only several $1 million commercial project, I want an even higher return because of the time and effort it's going to take me to do a relatively small project. We're seeing residential and commercial industrial rooftop solar returns about the same. So there's not a whole lot of distinguishing returns between residential and commercial rooftops. The market for rooftop solar is still maturing, and there's significant variation between projects, so there's more variation in return levels. So you have more outliers that are either below or above the numbers here, just because the market's still developing and there's kind of less standardized practice and less transparency in terms of bidding processes and such, so that you see a wider range of returns. Tax equity supply and demand. This is something I find personally interesting. So if you get a 7% after-tax IRR, which is actually low, right? So that's even on the low side for wind. It would be very low for solar. That's an equivalent pre-tax return of 10.8%, right? So it's equivalent of making a regular loan at almost 11% interest rate. So with taking into account the fact that it's after-tax, a 7% after-tax IRR equates to a loan at almost an 11% interest rate, and that's ignoring state taxes. So what other investment has a comparable reward for this risk? It's very, very high return relative to the risk. And you say, well, why is that? Well, tax equity investors can demand a premium due to a limited number of them. Really, to be an effective tax equity investor, you generally have to be a public corporation that consistently owes taxes and has capital available to invest outside of their core operations. So you have to be a public corporation because you're a private business. You're probably a pass-through entity like a partnership or an LLC taxable partnership with individual owners, and there's limitations on the ability of individual owners to use these tax benefits. And you have to have cash available, so you have to not be using all your cash in your core operations. If you're spending all your cash in your core operations, how could you make a tax equity investment? So that leaves a relatively small group of tax equity investors, and because they are a relatively small group, they're able to demand returns that probably exceed the business risk they are taking because there's a scarcity of supply of tax equity. So it's a pretty good business. So if you are a public corporation, you consistently pay taxes, and you have some extra cash you don't need to put into your primary operations, it's definitely something you should be thinking about. The returns have been coming down slightly, as we talked about. So more tax equity investors have been entering the market. The market's been getting a little bit more standardized. So we're seeing progress in this area, but it's still a pretty nice premium to be a tax equity investor. Although there is this premium, if you're willing to bear the premium, you could generally raise tax equity for your project. So it's not like projects are not getting financed because of an inability to find tax equity. They generally find it. It's just arguably expensive relative to the risk profile the tax equity investor is taking. So partnership flip structure overview. I'll give an overview of the partnership flip structure and then let my colleagues from Alpha Energy Advisors go more in depth. So we have here we have a diagram, and the yellow triangle is a project company that's taxed as a partnership. So it's a pass-through entity taxed to the partnership. The tax attributes flow through. It enters into an offtake agreement typically. Occasionally we're seeing what's called merchant projects that don't have an offtake contract, but it typically enters into an offtake agreement of one form or another to sell its energy in exchange for payments. Sometimes it's a hedge, sometimes it's a power purchase agreement, sometimes it's a net metering arrangement, but it's some sort of contract whereby the project company has some certainty as to what it'll be paid per kilowatt hour, and then has an obligation to deliver energy to the off-taker who's going to pay it. And then at the outset, the tax attributes are shared 99% to the investor, so that the investor gets 99% of a tax credit, and 1% to the sponsor, so the sponsor gets 1% because the sponsor, in theory, doesn't need the tax credits, because if it did, why would it be entering into a tax equity deal? And then that's also the same for the tax losses as a result of depreciation and other deductions, and it's a bottom line allocation that we do generally, whereby you're allocating the bottom line taxable income or loss 99% to the investor and 1% to the sponsor. After the sponsor achieves its after-tax IRR, which is what's described in the revenue procedure. The revenue procedure is based on a flip occurring upon achieving an after-tax IRR. The ratios change, and the tax equity investor is required to at least have 5%, and the sponsor 95%. So the tax equity investor can require more or negotiate for more than 5% if it wants to, but 5% is the floor. And generally the cash has to also at least be 5% to the investor. Sometimes the investor looks for more cash to improve its returns, but the floor on the cash is also 5%, leaving 95% of the cash for the sponsor. So as I've described it, we've got the tax attributes being allocated one way before the flip and another way after the flip. As will be addressed in some later slides, there's also a structure out there that's a time-based flip, whereby the flip occurs not based on achieving an after-tax IRR, but based on the passage of time, like 5 or 6 years. In PTC deals, we also see what's called pay-go payment, whereby if the PTCs produced exceed a certain level, the investor agrees to put in more money for those kind of additional, PTCs in excess of the agreed levels. The investor, during the course of the 10-year PTC period, may be making periodic contributions to reflect the fact that it got PTCs in excess of an expected level. So that's that slide. So the cash, again, talking about this revenue procedure 2007-65 structure, can be distributed in the same manner that the tax items are, or in a different manner. So the cash is more flexible. So those ratios on the prior slide do not necessarily reflect how the cash is being shared, although in the back end, after the flip point, the tax equity investor does need at least 5% of the cash. Generally, the sponsor has a purchase option after the flip point. The revenue procedure says that option can't be exercised during the first 5 years. And in a solar deal, you wouldn't want to exercise it in the first 5 years anyway, because that would result in recapture of the investment tax credit. So generally, after the flip point occurs, the sponsor has a purchase option. The revenue procedure permits that purchase option to be based on a fixed price that's projected to be a reasonable estimate of fair market value. And we see that in some deals, but not all deals. It's a little more common in wind deals because the revenue procedure specifically addresses wind while it doesn't specifically address solar. We don't have a solar revenue procedure, but it's not even included in all wind deals. Sometimes in a wind deal you'll see a then fair market value purchase option. That generally turns on how the negotiation goes between the tax equity investor and the sponsor. So the partnership flip structure has some advantages and disadvantages. So we'll just run through these advantages. One advantage is that it's quite flexible and it allows for efficient monetization of 99% of the tax benefits. Another advantage is, at least for wind, we have a safe harbor. So the IRS has given us some pretty comprehensive guidelines as to how to structure wind deals. For solar, it's a little more reasoning by analogy and such because we don't have a revenue procedure for solar. It's widely used and pretty accepted structure. The sponsor's purchase option is less costly than in, let's say, a lease structure because when the sponsor, if it chooses to exercise its purchase option, it's only buying back the flip down portion of the investor's interest. So if the investors flip down to 5%, the sponsor only has to buy back that 5% interest, while in, let's say, a sale leaseback, the sponsor would be buying back the whole project. So it's a less costly purchase option you see in a sale leaseback, and it can be used for ITC or PTC. In the case of, let's say, a lease structure, leases don't work for PTC. They do work for ITC. So it works for both types of tax credits. There are some disadvantages. The sponsor must have at least a 1% interest in tax items and depreciation. So you're not monetizing that 1%, while in, let's say, a sale leaseback you would be. And also, the partnership itself is viewed as a taxpayer, so it has what's known as a short first year for depreciation purposes, and that results in a haircut to depreciation in the first year. That depreciation gets pushed out over the remaining 6 years of the depreciation period, so it's not a loss of depreciation. It just means less depreciation in the first year. In the case of ITC, the investor must be in the partnership prior to the placement service date. That requires the investor to put in at least 20% before the placement service date. The investor does have some exposure of what if it's put in that 20%, which generally occurs to what's called mechanical completion, meaning the solar project appears complete, but it hasn't interconnected to the grid. It hasn't started selling power. What happens if something happens between when the investor puts in that 20% and when it's placed in service and fully operational? So that's a wrinkle you have to deal with in ITC partnership deals. And then there are complicated partnership tax rules and financial accounting, which my colleagues from Alpha will be now addressing. So hand this off.
Hello, this is Ginter from Alpha Energy Advisors. So here is a numerical example of a partnership flip structure. The ultimate objective is to allocate tax benefits to a party that can use them most efficiently, and there are many variations of this basic structure. So in this particular example, 99% of tax benefits pre-flip go to tax equity. In some deals, this ratio can go down by 1/3 or to 67% pre-flip to reduce pressure on tax equity's capital accounts and outside basis. On the cash side, cash sharing pre-flip can be anywhere from 0 to 100% as long as tax equity investor achieves, let's say, 2% pre-tax IRR over the project life. And as David mentioned, post-flip, at least 5% of cash and tax benefits go to tax equity. Again, these ratios can be higher, subject to reaching 2% pre-tax IRR over the project life. The flip date is typically year 10 for wind, which coincides with the PTC period. For solar, it can vary, can be 5, 6, 7, 8 years, or even longer. And as David mentioned, there are two types of flips. One is yield-based flip, where a tax equity investor flips when they reach target after-tax return, or the flip could be simply based on the passage of time. So this is time-based flip structure. So the next slide about the key considerations in the partnership flip structure. So how much tax equity can be raised in the partnership flip? It's usually up to 70% for wind and up to 50% for solar. Now, some tax equity investors are sizing more conservatively now due to the potential of tax reform. They are assuming 25% income tax rate starting in 2018. So we talked in the previous slide about sharing ratios, and these can be negotiated in different ways. Tax equity IRRs are in the 7 to 8.5% range for the utility scale projects and higher for residential and C&I solar. And it's also important to keep in mind the cash-on-cash return IRRs for tax equity investors. So these IRRs also include ITCs and PTCs in the calculation. Now, each partnership has to comply with very complex partnership taxation rules. So we talk here about capital account and outside basis, which usually have to be above 0. And there are several mechanisms that help to address the issue when the capital account and outside basis go below 0. And David mentioned the deficit restoration obligation. You also can have debt at the project level. There are stop loss reallocations, access distributions available, and really, if nothing of that works, basically the losses get suspended and monetized in future periods. This means that the structure loses its tax efficiency, so you would like to avoid this to the extent possible. Publicly listed corporations, they are very much concerned about the U.S. GAAP impact on their earnings. So these partnership flip deals are usually accounted using the hypothetical liquidation with book value method, which can produce sometimes counterintuitive results. So we'll have an example later on about HLBV for wind and solar projects. Now let's take a look at the numbers. How would tax reform impact the actual wind and solar projects? So as David mentioned, there are multiple proposals, but I think the most likely potential change is the reduction in the income tax rate. So in our numerical analysis that follows, we assume the 25% income tax rate in our base case starting in 2018. So first, let's take a look at new wind PTC projects with 2018 COD date. And so in this example, you see 3 scenarios. So scenario number 1 means no tax reform, 35% income tax rate. Scenario number 2 assumes 25% income tax rate starting in 2018. And scenario number 3 assumes 15% income tax rate starting in 2018. So as you can see, tax reform would reduce the amount of tax equity funding in the capital stack. And actually the change would be quite significant. So for example, if you raised 68% of tax equity for a wind project without tax reform, if the tax rate dropped to 25%, you would raise approximately 62%. So that's about 6% decline in the capital stack. Quite a significant number. Now, immediate expensing of equipment costs would increase tax equity funding by 1.5% of capital stack, but tax investor would have to agree to a substantial DRO to make this work. Now let's take a look at the returns. Again, here you see the 30-year unlevered IRRs at the project level, as well as for tax equity investor and the sponsor. So in our base case, which is scenario number 2, we assumed 25% federal tax rate in 2018. So as you can see, the tax reform reduces cash equity IRRs, sponsor IRRs. Cash equity bears the risk of tax reform. And the tax equity investor is made whole through either higher pre-flip cash allocations or cash sweeps, or the sponsor would need to put more money into the deal. So all in all, the tax reform would be negative for the new wind projects with the 2018 COD. Now, if we look at the older vintages, let's say here is an example of 2015 COD wind project, then the picture changes dramatically. Now, since the tax benefits have already been monetized at a higher rate, so basically a larger portion of makers, depreciation, and a portion of PTCs are monetized at 35% rate, then the resulting reduction in tax rates would be positive for the project, for the tax equity investor, and for the sponsor. And here is the CLE information. I would keep the slide on for a few seconds so you can write down the information, and we will post the presentation online after this event, so you will be able to access it as well. Okay, the next slide. Now let's take a look at the tax reform impact on solar ITC yield-based partnership flip deals. So similarly to wind, here is an example of 2018 COD solar ITC yield-based project. So the tax reform would reduce the amount of tax equity funding in the capital stack. However, the impact would be much less significant compared to wind. Again, immediate expensing of equipment costs would help somewhat, but would create also structuring challenges for tax equity investor, because the outside basis would be driven down below zero. If you look at the IRRs, the tax reform is fairly neutral to slightly positive for new solar projects. I think in this case, the back-end tax savings are higher than the loss of tax benefits in early project years. And here we look at 30-year unlevered IRRs, just to remind you. Again, in the new deals, sponsors do take tax reform risk, and if anything negative happens, they would take all the risk, and tax equity would be made whole. Now, if you look at the older vintage solar ITC yield-based projects, then the tax reform impact is positive. Again, since the ITC is monetized under 35% income tax rate, and the majority of makers also monetize under 35% income tax rate, so the remaining lower tax rates would actually reduce your tax liability going forward. So both cash equity and tax equity investors would be better off as a result of tax reform for all the vintage solar projects. Now I would like to ask my colleague Vadim to continue.
Hello, everyone. This is a continuation on the solar projects using the time-based partnership flip structure. As previously covered, the difference between the yield-based and time-based is that the yield-based has a target yield for the tax equity investor, whereas in the time-based flip, we've got a certain date when the sharing ratios flip down for the tax equity investor. Directionally speaking, you will see similar impact the time-based partnership flips as you saw for the yield-based. So let's speak first on the capital structure. As you can see, the impact of the tax reform would minimize, reduce the amount of tax equity funding in the capital stack, roughly by 1.5–2%, going from scenario 1 to scenario 2 to scenario 3. And one interesting note, it's more of a general comment, that time-based flip structures typically raise less tax equity capital when compared to the yield-based flip structures. And there aren't that many investors that are doing time-based flips nowadays, and we want to predict that even those may at some point maybe migrate to yield-based structures, but we'll see. Next slide. This is the analysis done for 2018 COD time-based flip project. As you can see, again, we did the base case tax equity sizing at 25% for 2018, which is scenario 2, right in the middle of the graph. Tax reform would slightly increase both the sponsors and the tax equity IRRs. So the impact overall is positive over a 30-year period. Again, as mentioned in previous slides, for wind and yield-based partnership flip structures, the tax equity investor would be made whole through high pre-flip cash allocations or cash sweeps. So in terms of the yields, they're gonna still achieve those. Next slide. As far as operating projects, anything that occurred 2016 and prior, we looked at the 2015 COD project and analyzed what the impact would be. As you can see, directionally speaking, moving from scenario 1 to scenario 2 and from scenario 2 to scenario 3, we would see that both the sponsor and the tax equity investor would effectively win in terms of the economics that they're going to achieve as a result of a decrease in the federal tax rate. And that is explained primarily by the fact that a large share of tax benefits have already been monetized in year 1, 2, and 3. So that's why you see this positive impact. Additionally, the taxable income that's generated by the project after the 5-year makers would be taxed at a lower rate. So again, it's a good thing for the project and for all the participants. As mentioned before, tax equity investor IRRs are actually much higher in time-based partnership flip deals as opposed to yield-based flip structures. And as also mentioned, the time-based partnership flip structures would raise less tax equity for the project. So now we're moving on to the summary of what's been presented. I hope this slide would be more useful and put in a better context. So let's speak first about the amount of funding and how it's going to change. So for all new projects starting in 2018, the lower tax rates, be it 25 or 20 or 15, whatever that might be, it will reduce the tax equity funding in the capital stack, and that's going to be due to your lower tax shields from maker's depreciation. As previously mentioned, even though it would reduce the amount of capital, that doesn't really mean in context of the industry that there would not be sufficient capital for projects to be funded. I think there is plenty of capital to fund good projects, so really everybody is on the lookout for a good project. I think that's probably a bigger problem for people. So moving on to the next bullet, we put together a summary of the previous slides that analyzed the impact of the tax reform. As you can see, wind projects would have a negative impact as a result of the tax reform, and one may see anywhere between 80 to 140 basis points decline over a 30-year period. Again, different projects may have different economics, but I think this is kind of the range that we anticipate to see for good performing projects. On the bright side, solar projects would actually experience, the sponsors of solar projects would experience an uplift in their IRRs over a 30-year period, and that's going to be around 20 to 30 basis points. As far as the tax equity investors go, as mentioned before, there are mechanisms to make them whole. So generally speaking, we should not see a significant impact to their IRRs, even though, especially in context of the yield, in year 6 or 7. But in context of a 30-year period, to the extent that they do stay on, you may see 10 or 20 basis points increase in their economics. Again, as mentioned by David and Gintrust, the sponsor would bear the risk of the tax reform, and most of the agreements are structured that way. Whether they're structured one way or another, the sponsors would still bear the risk. So this slide is going to cover the impact on the existing wind and solar projects. So the first bullet is for all operating wind and solar projects with 2016 and before vintage. Low tax rates would actually translate into higher IRRs for the sponsor over a 30-year period. As you can see from the table, depending on the scenario it's going to play out in 2018, whether it's 25 or 15%. Federal tax rate, we may see anywhere between 50 to 150 basis points increase for the project. So it's a good thing. In terms of the tax equity investor, they will see an improvement as well, 10 basis points for wind, and could be anywhere between 40 to 110 basis points for solar. Again, that's due to lower taxes after the end of 5-year maker's depreciation period, and the fact that all of those benefits have been monetized previously at 35% tax rate. So next slide, please. So what are the structuring and other considerations that one must be aware of? New projects, we will see a lower amount of tax equity funding that would be raised in the capital stack. Secondly, there would be some sort of a make-whole provision to the tax equity investor that's going to be done most likely through a cash allocation ratio adjustment in case the tax rate does go down to a low rate, than 35%. In terms of using bonus depreciation, as was mentioned, this is something that clients should definitely explore for 2017, as well as for 2018, to the extent no reform occurs in 2018. again, subject to limitation in outside basis. So I guess what can we do? Wind is the one that's going to be impacted the most in a negative way. So to the extent that possible, we've got to improve the overall wind project economics, which could be used via the use of latest technology, increased PPA rates to the extent possible, reductions in operating costs, or financial structuring options. Sponsors of new solar projects will see an upside due to the tax reform, as mentioned in the previous slides. All in all, existing wind and solar projects, they will become more valuable if tax rates are reduced as a result of the tax reform. Now we're moving into the next subject, which is important for public companies, be it here in the U.S. or subject to IFRS reporting. And we're going to be showing the earnings profiles for wind and solar projects, and we're going to compare them on a pre-tax basis. So let's move on to the next slide. So what you see here is a pre-tax earnings profile for a typical wind yield-based partnership flip structure and a typical solar yield-based partnership flip structure. Again, the graph that you see represents the pre-tax earnings profile, not after-tax. I want to make that distinction. As you can see, over a 30-year period, wind would have a more negative impact for the tax equity investor as opposed to the solar yield-based, where you can see only year one and two tend to be negative. For the cash equity or sponsor, the earnings impact on the pre-tax basis is positive, as you can see in the lower portion of the slide on the left and on the right side, Class B cash equity, pre-tax net income. So that's kind of in a nutshell about the differences in the EPS. And the next slide would actually put together the solar ITC projects together using the two different structures, the yield-based and the time-based, and we're going to see if there's a big difference. So next slide. As can be seen graphically, the pattern is almost identical, with a small exception that the time-based flip would have a smaller negative impact in year one as opposed to year one for the yield-based solar project. Again, if you combine year one and two, most likely it's going to be identical. Again, on the cash equity or sponsor side, we see a positive earnings recognition pattern. Now I'm going to hand my piece of presentation back to David, who will cover other slides on the start of construction rules.
Thank you, Vadim. That was interesting about the HLBD. We've received a few questions about the presentation so far, and I thought it might be helpful if we took a pause to answer those questions before turning to start of construction, because start of construction is kind of a different topic, and these questions tend to be around returns and IRRs and capital amounts and such. So I'll read the questions and give my thoughts, and then the team and Chantaris can chime in with what they think. So one question: in solar for finance deals, what is the percentage share of the market between sale leaseback, flips, and inverted leases? So what I would say is that in solar, certainly what I see the most of, and I think there's probably consensus around this, is partnership flips. More than half of the market is partnership flips in my estimate for solar tax equity finance deals. And then the next thing would be sale leasebacks. So well less than half the market, but still material. And then inverted leases have become a little bit rare. And I would say 10% or less of projects are being financed with inverted leases. But if there's a inverted lease investor out there who disagrees, please email me. I'm glad to hear a different perspective on that. Vadim or Ginteris, do you have thoughts on the structures for solar?
I think we agree with your assessment. We typically see partnership yield-based structures. They seem to be more prevalent. We do see sale leasebacks, but again, I think our main focus has been, and maybe that's partially due to our client base. It's partnership yield-based flip structures.
Okay. Alrighty. Next question. In the market today, what is preferred, time or yield-based flips? So the person asking the question doesn't specify wind or solar, but you really don't see time-based flips in wind because the wind safe harbor doesn't include a time-based flip. So for wind, it's really all yield-based. So solar, you do see both structures. Generally, in solar, what I see is that investors who got into tax credits through the historic tax credit, what's known as the rehabilitation tax credit for historic buildings, they tend to use time-based flips, while investors who got into solar, having first invested in wind, they tend to be more comfortable with the yield-based, IRR-based flip. I think I can confidently say there are more investors comfortable or using the IRR yield-based flip than there are the time-based flip. But there is, one very large investor who uses the time-based flip quite frequently and is a proponent of it. Vadim, Ginteris, do you have thoughts on that one?
I think that's pretty much accurate.
Yeah. Let's see. All right. Then we come to why does tax reform hurt new wind projects, IRRs, and tax equity sizing so much more than new solar projects? I'll take a stab at that, and certainly Dean will be interested in your thoughts. So I think there's two factors that make wind more sensitive to tax reform than solar. One is that in solar, with the ITC, your basis is reduced by half of the 30% ITC. So the ITC is 30%, and then your depreciable basis, your maker's basis, is reduced by 15. So the project costs 100, you get a $30 ITC, you depreciate 85. There's no basis reduction for PTC for wind. So for one, wind has more depreciation. The other thing is that as a general matter, and I think there's always exceptions, but as a general matter, wind PPAs tend to be lower priced than solar PPAs. So that means solar has more pre-tax revenue and therefore more taxes to pay. So therefore, solar benefits more from a lower tax rate than wind does, where wind has very low priced PPAs and not a lot of tax to pay. Vadim, you have thoughts on that one?
That's accurate. It really is, the way we look at it is even on a simpler level. We'll look at a solar deal as a 5 to 7 year deal as opposed to wind, which is 10-year deal. And ITC is monetized in year one for solar as opposed to wind. PTCs are being monetized over a 15-year period. So really that's probably one of the main reasons. So I think that's all I would add.
All right. Then we have a question about community solar projects. It's sometimes called community garden solar projects. Why are the IRRs for community solar projects, or what are the IRRs for community solar projects? Same, 7 to 8.5%. for community solar, because it's new and there are not standardized rules around for it. Some utility districts don't permit community solar, and then the utility districts that do permit it each have their own rules for it from a utility regulation perspective. I'm generally seeing community solar IRRs higher than utility scale. So even though it may be a utility scale size project, because the tax equity investor has to incur the brain damage to figure out how the community solar works in the particular utility district and what risks it has in terms of regulatory or in terms of the community members who are buying the solar, canceling their contracts and such, they tend to want a premium above maybe the 7 to 8.5% for going through that effort. But there's exceptions to that, and I'm generalizing. And community solar is still pretty new, so and it doesn't really have a kind of uniform market behavior yet. But Vadim, what have you seen in terms of community solar?
It's definitely we do see projects in the development, so I think it's really an interesting niche. So I think we yet have to see how it's going to play out, but overall it's definitely a new direction. So we have looked at probably about 3 to 5 deals. We haven't closed any yet, but I think it's definitely a very interesting niche.
Okay. So then we have another question about tax rates. So an audience member writes, it seems counterintuitive that a lower tax rate on an operating solar project, all else equal, would have a positive impact on existing tax equity investor in a project. Can you summarize why again? Vadim, you want to take that one since you guys did that analysis?
Well, I think it's due to the maker's monetization. So any operating project that has been in existence anywhere between 1 to 3 years has already monetized a large share of depreciation. So that's just the way the NPVs work. So and IRRs.
Then we have another question. How would the tax reform impact sponsors' decision to go for ITC versus PTC for wind? So for wind, but not for solar, you have a choice to claim either a 2.4 cents per kilowatt hour for 10-year PTC, production tax credit, or the 30% investment tax credit. So for wind, you have a choice. And generally, it's just a matter of a discount rate exercise. So you discount, meaning you present value the 10 years of PTC based on your projected production at whatever you think your appropriate discount rate is, or the tax equity investor's appropriate discount rate, and you see if that's more than 30%, then you go for PTC. If it's less than 30%, then you go for ITC. In my experience, particularly with the technological improvements leading to higher capacity factors and turbines that can produce more power with less wind, I generally see projects going for the PTC. An ITC wind project, they occur, but they're rare. They're a small minority. So then I think you get to the question of how that fits in with the lower depreciation amount for ITC, and that lower depreciation not being less affected by tax reform. So I think you would still do that discount rate exercise, but then maybe you'd also factor in depreciation, and you'd see which one has a bigger benefit. With the ITC depreciation rules being a bit of a mitigant to the lower tax rate, and PTC not having that benefit. I suspect, but I don't know, that sponsors are still going to go for the PTC. That's still going to be more attractive. But I could be wrong, and that will certainly vary by project. But Vadim or Ginteros, what do you think? It's you guys do more modeling, or do modeling, and I don't. So what are your thoughts?
Typically, when we look at wind, it would typically be PTC as opposed to ITC, simply just in NPV terms, it's just you get a better economics out of the project. We've participated only in one deal that used ITC and a cash grant in the past. Well, 2 projects. So really, we don't see any win ITC deals. Some clients ask us to analyze which one is more attractive, but we pretty much know the answer before we sit down to analyze it. So it's win PTC. ITC is typically for solar. So.
And you don't think tax reform is really going to change that balance?
I don't believe, we haven't conducted an assessment, but I don't see why it would be the case. I mean, again, PTCs are tied to your generation, and they are over a 10-year period. So, I mean, once you multiply, the PTC rate times your megawatt hours generated during a 10-year period, I mean, it's just a high number. So, than a 30-year ITC.
All right. Let's see. We have one question still to go. I'll read it, Vadim. I'll let you tackle it. But I'll read it. I think I follow what the person's asking, but there's a little bit of ambiguity in it. In the sponsor/investor 30-year IRR analysis presented, the returns for solar ITC time-based flip is larger for both sponsor and investor compared to the yield-based flip structure, meaning the project IRR is higher. What can this be related to? So I think they're asking what is the cause of the higher returns for both the sponsor and the investor in the time-based flip versus the yield-based flip. Any thoughts on that or?
For the tax equity investor in the time-based flip, you put in less tax equity, and you'll see a flip in year 6. So it's just probably about a percentage point. And generally speaking, when you look at the time-based flip, and that's probably the reason why we typically don't advise the sponsors to enter into it, is simply because you just give out too much to the tax equity investor over the long term. They tend to be a little bit less economical than the yield-based structures.
Okay, great. So that's the questions we have so far. We'll put the questions and the answers on the Tax Equity Times blog and send around an email with a link to the blog post, and the blog post will also have the presentation, the slides. So now we're going to turn back to the presentation and tax credit eligibility, start of construction rules. So this is what you have to do to qualify for these wonderful tax credits. So far, the solar industry doesn't have to contend with this, but the wind industry has been living with it for several years and has had to develop means of meeting these rules. So first we'll talk about the tax credit extension for wind projects. So wind projects qualify for the PTC, which is 2.4 cents per kilowatt hour. That will continually to be adjusted by the IRS for inflation. So it may seem a little bit counterintuitive that we have this PTC phase out, but we also will have every other year or so approximately. But the IRS will adjust the PTC for inflation. So, for instance, they recently raised it from 2.3 cents to 2.4 cents. And they do their own kind of proprietary study to determine when to raise it and how much. There's not a lot of visibility to that, but it is kind of every other year is more or less the pattern, but it doesn't have to be that. So the credit will ramp down based on when the project starts construction based on the following schedule. So for instance, if you started construction this year in 2017, you'd get only 80% of the credit. So if you have a project that starts construction in 2017, you get 80% of 2.4 cents or 1.92 cents. If you have a project that starts construction in 2020, but for a change in law, you get nothing. The PTC is over, and there's nothing. Most projects have managed to start construction under the rules we'll discuss prior to 2017, so they qualify for the full PTC because their sponsors took steps to meet those rules. So so we're not seeing a whole lot of projects that are only at an 80% PTC. And as we've mentioned, wind project also has the option to claim the 30% ITC, and that would ramp down in the same pattern. So the same percentages would apply, so you'd get less than the full 30% based on these percentages. The tax credit extension for solar is a little bit different, a little bit more generous. So right now we still don't have to be concerned about start of construction for solar because because if you have a project that's placed in service, finished in 2017, obviously it started construction before 2019. So it's only going to be projects that are going to be finished after 2019 that will start to focus on placed in, on the start of construction rules for solar. So right now the solar industry is still kind of blissfully not having to contend with these rules. So this is something that they're looking at down the road, but it's not something they have to confront at the moment. Unlike wind, solar has a drop dead date for placed in service. So all these rules have been focused on, well, when do you start construction? And I'll get into what it means to start construction. But unlike in wind, that's all that matters, right? For solar, they also have a placed in service deadline. So Congress, for some reason, for solar, felt the need to say, well, to get more than a 10% ITC, you have to be placed in service by 2023. So Congress is saying, well, even if you started construction of your solar project in 2017, let's say, if it's not placed in service by the end of 2023, meaning it's placed in service in 2024, you're only going to get a 10% ITC. So Congress put a cutoff for wind, but didn't. However, as I'll get into, the IRS's guidance has a soft deadline for wind that basically, if you want to meet a safe harbor, prevents you from kind of waiting indefinitely to actually finish your wind project and have it placed in service. So the IRS kind of stepped in and filled that gap that Congress left for wind. So start of construction guidance, the IRS has issued new guidance for wind. We're still waiting for solar. So for wind projects that are in service after 2017 and solar projects in service after 2019, as we talked about, the amount of the credit will be determined by when construction started. Start of construction is defined in a series of IRS notices, and the IRS has updated those notices from time to time. The most recent update was issued in IRS Notice 2016-31, and that said that wind projects have until December 31 of a year that included the 4th anniversary of the start of construction date to be placed in service. So, for instance, if you start construction January 1, 2016, then the project must be in service by December 31, 2020. And if you're not in service by December 31, 2020, you could, in theory, still qualify for the full PTC, but you'll have to prove that you did continuous work or the continuous construction requirement. And that can be a little bit challenging, and there's some ambiguity as to what exactly continuous means. So generally, sponsors and tax equity investors and their tax counsel want projects to meet this 4-year safe harbor and be in service by the December 31st of the year that includes the 4th anniversary of when you started construction. So that's important to the wind industry to keep its eye on. And as I said, solar has this 2023 deadline that Congress gave it. The IRS said in Notice 2016-31 that it's working on guidance for solar. Conversations with the IRS attorneys working on it suggest that work continues, that they continue to work on it. but it's unclear if President Trump's executive orders regarding regulatory guidance will impact it. So I certainly hope they don't impact it, but the scope of those executive orders regarding regulatory guidance is less than clear at the moment, so it's a possibility they could. But the IRS is continuing to work on it. I hope they're getting close and that we see it soon, so that the solar industry can start to plan how it's going to meet the start of construction rules as those rules start to become applicable to solar projects. So then, what does it mean to start construction? It doesn't mean sort of what if you asked a fifth grader, what's it mean to start construction? Well, how they would probably define it, meaning bulldozers and equipment and lots of people in hard hats, doing work every day. It doesn't mean that. You have two methods to start construction. One is you do physical work of a significant nature, or alternatively, you incur 5% of the cost of the project. So you can incur 5% of the cost of the project and not even break ground and still be deemed to have started construction. Generally, sponsors and tax equity investors prefer the 5% route because there's more certainty around it. It's more of a paperwork exercise to diligence rather than these questions as to, what physical work was done and what was significant. But certainly we see projects using both methods, and over time, the physical work, the significant nature method has become more accepted within the industry. But if you have a choice between the two, if you have the cash, go for the 5% method. But there's some sponsors that don't have the cash, and they've done physical work of a significant nature, and they've been able to properly comply with those rules and raise tax equity and give tax opinions and have the whole thing hold together. So both routes have been pursued. 5% is a little bit more common and a little bit smoother of a path to follow, but physical work does happen and is viable. If you go the 5% route, there's some rules to keep in mind. One is that you have to have the equipment delivered within 3.5 months of payment. So if you make your payment on December 31st, you have until April 15th of the following year to take delivery. So it's not just, some people think, all I have to do is write a check. No, you do have to write a check, but also you have to take delivery within 3.5 months. So the manufacturer you're writing that check to needs to be able to make the equipment and get it to you within 3.5 months. It doesn't have to get it to you in the United States. It can get it to you at a warehouse outside the United States. You just have to have taken delivery of it. And what it means to take delivery is going to depend upon your historical behavior and what accounting methods you have established as to how you take delivery. And then another thing to keep in mind is that if you want your manufacturer to provide vendor financing, if you go to your manufacturer and say, hey, I want to do this 5% test, but I don't have the cash, can you lend me the money? You can do that, but then you don't get the advantage of the 3.5 month rule. So if you're going to use vendor financing, you have to take delivery by December 31st of the year that you enter into a contract and purchase it. Both methods follow the Treasury Cash Grant Guidance under the 1603 program that was issued in 2009, but with some differences. So you can't just blindly do the same thing you did in the Treasury Cash Grant Guidance, but they're generally aligned, but there are some differences. In terms of physical work, the IRS has clarified that there's no minimum level of work required to meet that standard. So based on an example, we used to be concerned that, if you were going to do physical work like digging turbine foundations, you had to maybe dig 20% of your foundations. Well, the IRS has said, no, there's no minimum. So qualifying work for wind projects includes operational road construction, as I said, digging turbine foundations, manufacturing a customized step-up transformer, manufacturing other equipment not held in inventory by the manufacturer. But they don't tell us, a minimum amount of road you have to build. So that's a common question. But the IRS has said there's no minimum. You just have to do the right kind of work. Another foot fault is that if you're not going to do the work yourself, if you're going to hire a contractor, as most project owners would, you have to have a binding written contract. And that has certain technical requirements, so obviously it has to be in writing because it's a binding written contract. It has to be binding under state law. It either has to not have liquidated damages, or the liquidated damages have to be at least 5% of the total payment due. Or you can just be silent on liquidated damages and just have it provide that, whatever, a judge applying state law determines the damages are, that would be what the damages are. But if you want to limit the damages, the limit can't be less than 5% of the total payment. So definitely you want to get advice if you're going to be following these rules and entering into binding written contracts, because small drafting issues can cause you problems, and you can avoid some headaches to get advice in advance. So I think it's worth spending the money on tax advice in this area rather than trying to do it yourself and then having issues that get identified when you go to finance your project. So that's it. We have 2 minutes to go, so I think we stayed on track pretty well. If there's any final questions, we can try to answer them. Otherwise, we will wrap up, and as I said, we'll put the questions on the website, on the blog, taxequitytimes.com. We'll put the presentation on the blog, and we'll send everybody who registered an email with the link to the blog so they can access that. We very much appreciate everybody dialing in and taking the time and their interest in these topics. And if you have follow-up questions or otherwise, want to discuss this more, feel free to reach out to any of the three of us. Thank you so much. With that, I think we're done. Thanks a lot. Have a good day.
Thank you.
Thank you. And thank you, ladies and gentlemen. This concludes today's conference. Thank you for participating. You may now disconnect.